Anish Shah, Group CEO and MD at Mahindra Group, joining in for his first reaction on the budget. Mr. Shah, great to have you on ET Now. Thank you for your time. What did you make of the budget while we're still scratching with the nitty-gritties and the finer print?
Look at the medium to longer term because that's important for India. And in that context, this is really an excellent budget. It does a lot to sustain the economic growth momentum that we've got and recognize that with the world around us being so crazy, we've still been able to maintain that momentum. A number of reforms that have taken place in the past few years have helped that. And what we see here is further building blocks, a continued focus on capital expenditure. And that comes after multiple budgets that have focused on capex, and that will continue to help building the foundation for India. A continued focus on infrastructure build, bringing in SMEs to be part of the growth story, which is essential. And all of that's going to make India more competitive from a manufacturing standpoint and be able to make in India for the world. This budget also focuses on Atmanirbharta. The rare earth corridor is something that's very welcome and much needed. And most importantly, on inclusion, as it looks at a wider participation in the benefits of economic growth across small and marginal farmers, across women, and then the capacity building for youth. I think all of these things augur very well for India, and therefore we would look at it that as truly an excellent budget.
Mr. Shah, defense capital outlay has been increased to 2.19 lakh crores. That's nearly 17-18% jump in defense outlay. Do you think that's a good signal that the government is giving, especially for defense manufacturers, and you are also involved in defense manufacturing?
Yes, so we focus on security and transportation solutions, and that definitely is a good signal. But it is essential for India right now, as just the various geopolitical issues we see around the world. It is more a required step at this point.
Okay, Dr. Shah, a very last quick question. With regard to India-EU FTA, is how much of a material negative is it from an India auto OEM standpoint, given the fact that we are opening the Indian market up for European automakers to come in and sell here? So give us that perspective.
We don't see it as a negative at all from an India FTA, India auto standpoint, because there is no single model that will be brought in at a lower price than it is sold in India today. And we see a lot more opportunity in terms of India being able to export to Europe. The important part here is that the government has managed a very fine balance to be able to continue to encourage European makers to set up plants in India. That is what is essential for Make in India. And that balance has been done very nicely. And therefore, we see this as a very positive FTA.
Okay, Mr. Shah, great to have you today on ET Now. Thank you so much, as always, for your time. And we've got Sunil Singhania. You've always seen him on ET Now right after budget. Sunil, hi, afternoon. Sorry to keep you waiting, but you know how the budget drill is, as always. Sunil, what has disappointed the equity markets? Low volume day. Yes, it's a Sunday, but a 300-point fall in the Nifty alone.
So obviously, on the face of it, there is disappointment for capital markets. But, as we go through the fine prints, I think the outlay for railways, defense, infra seems to have increased. And I think that is one reason why the markets have bounced back. I think the only one thing which is a little disappointing, this tweaking of STT rates, capital gains tax rate every year, I think that unnecessarily causes irritants, And yes, it makes sense to discourage people to speculate, but we have to just put our thoughts together and say, this is what we are going to do, and now this is going to sustain for the next 3-4 years. Obviously, the buyback tax has come as a little bit of a positive, but I think if I've always said that if we have to go from 4 to 8 trillion, $10 trillion, particularly in a scenario where the world is so volatile, there are so many headwinds, multiple wars, this tariff thing hanging on it. I think we need a very, very conscious push. And I think to that extent, the market might seem to be disappointing, but, earnings will go on, stocks will go on. Let us see.
No, absolutely, Sunil. Life goes on, and we've seen that more than enough times in the market. But talk to us about the opportunity it holds today. This kind of dip that we've seen today in the market. Is it an opportunity, you reckon, just the volatility?
And I think if you are positive on India from a 3-5 years perspective, then every day is an opportunity. Just because the stocks have fallen 1-2%, the markets have fallen 1-2% today, does not make it more attractive or less attractive. I would say that read through the fine prints, see your asset allocation, see if you've already got equity exposure, stick to it. Don't jump in just because some stocks have fallen 2-5%. But I think it's very difficult to analyze everything in a matter of minutes and say, because of this, you have to do that.
The problem with equity market participants is that whatever's said and done, they're like, doesn't matter, put it behind us. India is a great story, right, Radhika? It is, yes, it does work out.
I mean, Indian equity markets and, capital markets have survived LTCG going from 0 to 10, 10 to 12, X, Y, Z, and, every time you write
COVID,
every time you write an obituary of equity markets, the volume seems to come back stronger. So I think what we have to have conviction on is financialization, participation, and the fact that more people will benefit from wealth creation and come forward. So, I mean, they're optimistic, but there's reason to be.
Yeah, absolutely. But, right now, as we see it, Sunil, the fact that you've had those $22 billion worth of outflows, has the budget done enough to get those FPI, FII flows back into equity markets? We need that right now. Of course, part of the reason is relative global strength in other markets, the rupee weakness, all of that coupled into. But can those flows after this budget find their way back? Or are they just waiting for the India-US trade deal?
No, Aisha, I was just adding to what Radhika said that, 10 to 12, 0 to 10 and all. But there's always a last straw on the camel's back. I think we can't bear more burden as far as capital markets are concerned. It is very, very clear. We can say all the good things on TV, but we have to be realistic. And, to say that capital markets are not very important for taking the economy to 4 to 8 to 10 trillion, I don't think that will be right. I think we have grown so much. We have seen the emergence of private sector. We have seen the emergence of so many sectors and companies who are investing billions and billions of dollars, all because the support of capital markets, be it equity as well as fixed income. And I think that is what has to be appreciated. And, it's okay to make money at some point of time, You just can't say that this participants are making more money, so tax them more. So I think whatever has been done so far, yes, we accept it. But I think going forward, I think there has to be, as I said, you announce that for the next 3 years, we will not tweak anything. And I think then life can be more predictable.
Sunil.
The pain, Sunil. We can hear it.
If I can take a question to you, Sunil, since you asked about bond markets, I'll take the liberty to ask a question. I think banking has been a part of financial services that hasn't done well. I think the FM outlined how banks are in good shape. You've seen large market borrowings. How do you see banking going forward post this budget?
I think banking as a sector has come, I would say, much ahead. NPAs are in control. I think the systems, processes, efficiency has gone up tremendously. Even if you see PSU banks, most of them have net NPAs of 0.5% or lower, which is like music to the ears. So, and I would say a lot of credit goes to the government because they've not interfered in the working of the banks as was the case earlier. And going forward, it's very clear that yes, we need a more vibrant bond market, but we will reach there. The only thing I'm trying to highlight is that if participants are clear about the taxation from a 3-5 years perspective, then the planning becomes all that more easier. This wild swings, whether it's the bond market or particularly the equity markets, don't infuse confidence. And particularly in a year where Aisha mentioned that, $20-25 billion has gone out by way of foreign outflows, I think you need a little bit more effort to ensure that, one, they stop this. And second is, how do you bring them back? Because ultimately, if foreign flows comes, rupee will be stable. I'm very sure this yield, which has gone down to 6.7%, will inch back to 6.3, 6.4%. And it would help all the constituents, including the bond markets, the banks, and the capital formation, which is the need of the hour for us to take the economy to $8 to $10 trillion.
Absolutely. Sunil, stay with us. Perhaps we've got someone joining in who shares the same thoughts. Sandeep Sikka, ED and CEO at Nippon Life, India Asset Management as well. Sandeep, hi, afternoon. Good to be speaking with you. Share the same pain as Sunil. There is only that much that you can take, and you need at least clarity on, what kind of thought process the government has on taxation when it comes to capital markets and F&O in particular.
Sure, I think I share. I mean, the one point that Sunil mentioned. In the first few minutes, it's very difficult to give a reaction. But let me see some positives in the budget. I think from our point of view, you should see basically the government continues the fiscal discipline that they started over the years, and whether the fiscal deficit also coming to 4.3%. I mean, that's a big positive. And also, I think never before we have seen a budget, which has gone so micro, going into micro details, whether to create a semiconductor fund of 40,000 crores, SME fund of 10,000 crores, medical tourism. So all these things are going to be very, very good from a long-term point of view. But short-term, I mean, when we look at, from immediate reaction from a market, these things are not captured. Coming to STT, definitely this has come as a surprise, I think, and too much of swing, change in taxation is never a good thing. But again, I'm sure there would be a thought process which we may not be able to analyze at this point of time, and could be trying to make a lot of these traders into long-term investors. That's the only positive I can see in this. Will it happen or not happen? Time will tell. But overall, I do not see the budget as negative as the market is seeing, because it has a lot of positives which will help India in long run.
Sunil, let me come back to you. From the budget, any structural themes that you're seeing in terms of a change? For example, the PLI scheme from 22,500 crore has been hiked in terms of the allocation to 40,000 crore. Material positive, you reckon? And is this a potential opportunity for early investors to jump on the bandwagon, if I can call it that?
One is, we continue to be extremely positive from a longer term perspective, and Aisha can make fun of it for the for the near term, but it's a fact. The other thing is one thing where there has been consistency from the government, over the last few years has been this whole focus on Atmanirbharta, manufacturing in India, and I think it continues. The sectors obviously keeps on getting added. So this time we have data center, and in fact, it's a big thing, because if you give tax holiday, technically all the data centers in the world will be more than happy to look at India from setting up a base as far as data center is concerned. And same is the case with infrastructure. I think the railways output, the outlay, the infra outlay, it's very clear the defense outlay has been increased. I think all these are consistent in the sense that government wants to encourage Atmanirbharta, whether it's through PLI scheme or increased outlay in terms of support and so on and so forth. So I think that continues to be a big thing. In fact, we have all forgotten the China plus one, which was very big because of all this tariff thing. I think once this tariff issue is solved, and hopefully it should be done sooner than later, we already have the EU large mother of all FTAs already been formed up. And I think this, the manufacturing bit and Atmanirbharta is something where we can see consistency and a lot of legs as we move ahead.
Well, Sunil, I was sympathizing with you because I do understand that, of course, this is going to impact volumes.
We need all the
STT, that
sympathy at
is.
this point of time, Aisha. We need all the sympathy.
But I do want to ask you right now, Sunil, what sectors, if at all, does the budget throw up in terms of long-term opportunities?
No, I don't think this budget is changing our view. I think we continue to be positive what we have always been. So financials, financialization of savings, manufacturing, particularly the engineering bit, the pharma bit, I think the sectors continue to be the same. I don't think the budget has changed anything as far as view is concerned.